Over $40 billion of institutional capital shifted away from tech stocks last week. Smart money is quietly positioning for a massive global market rotation starting next Monday. Central banks in Washington, London, and Frankfurt have held interest rates steady at 3.5%. Yet underlying volatility in energy markets is driving capital into entirely different sectors. Most retail investors are looking at the wrong assets heading into next week. They are chasing late tech rallies while institutional funds build defensive positions. If you want to protect your capital next week, you must adapt quickly. You need to align your trade setup with these big institutional flows. The current market condition is creating a distinct divergence between global regions. Inflation risks remain elevated across Europe and North America. That forces central banks to keep liquidity tight. Consequently, high valuation stocks face immediate downside pressure. Meanwhile, high dividend equities and low-risk bonds are seeing record inflows. You do not need complex derivative strategies to profit from this move. You simply need a clean balance of global equities, ETFs, and Treasuries. What most people do not know is that 3 global stocks are showing extreme technical coiled spring setups right now. Let us break down the exact individual equities you should monitor next week. We start in the United States with energy giant ExxonMobil. Exxon has gained over 20% year-to-date as oil prices firm up. Its price-to-earnings ratio sits at an attractive 14 times earnings. Energy demand remains structurally high due to global supply disruptions. Buying pullbacks near current levels offers a strong risk-to-reward setup. Next, look across the Atlantic to the United Kingdom. BAE Systems is Europe's premier defense contractor. Government defense spending across NATO members is rising toward 3% of GDP. BAE has a record order backlog exceeding £60 billion. It provides stable earnings growth regardless of short-term economic slowing. Over in mainland Europe, tech infrastructure giant ASML is a critical core holding. ASML holds a near monopoly on advanced semiconductor lithography machines. While consumer tech faces headwinds, industrial chip demand remains robust. Its current pullback offers a long-term accumulation zone for patient traders. Finally, do not ignore United States chip giant Nvidia. Nvidia continues to dominate artificial intelligence hardware delivery globally. However, next week requires patience on Nvidia. Wait for a minor retracement to key support levels before opening new positions. Before you skip to the next section, the surprising part comes next regarding diversified funds. Buying single equities carries individual company risk. You should balance individual stocks with broad market exchange-traded funds. ETFs give you exposure to hundreds of global companies in one trade. For American market exposure, the Vanguard S&P 500 ETF, ticker VOO, remains king. VOO tracks the 500 largest public companies in the United States. It carries an ultra-low expense ratio of just 0.03%. It allows you to participate in broad market gains with minimal fee drag. For European market exposure, consider the iShares Core EURO STOXX 50 ETF. It tracks 50 blue-chip industry leaders across the Eurozone. European stocks currently trade at a discounted valuation compared to American markets. That valuation gap creates a margin of safety for entry next week. For United Kingdom exposure, look at the iShares Core FTSE 100 ETF. The FTSE 100 is heavily weighted toward energy, materials, and financial firms. These sectors outperform during periods of persistent interest rates. The fund offers a generous dividend yield near 4% annually. Dividend yields provide consistent cash flow even if prices move sideways. If you are finding this actionable, hit the subscribe button right now. Subscribing ensures you never miss our daily market updates and trading blueprints. Now, let us tackle the asset class that most beginner investors completely ignore. That asset class is simple government bonds and treasuries. When stock market volatility rises, government bonds act as your portfolio shock absorber. With United States central bank rates holding at 3.5%, yield levels are extremely attractive. You can lock in reliable returns without taking on heavy equity risk. The simplest way to buy United States Treasuries is through the iShares 7 to 10-year Treasury Bond ETF, ticker IEF. IEF holds medium-term United States government debt securities. It pays regular monthly interest distributions directly to your broker account. If stock markets experience a sharp correction next week, bond prices typically rally. That inverse correlation stabilizes your overall portfolio valuation. European investors can look at the iShares Euro Government Bond ETF. It holds high-grade sovereign debt from Germany, France, and the Netherlands. United Kingdom investors should evaluate the iShares Core UK Gilts ETF. British gilts offer yields near 4%, backed by the UK government. Allocating 20% of your liquid capital to bonds protects your upside profits. What most traders realize too late is that position sizing determines survival. Here is your exact, step-by-step execution plan for next week. Do not deploy all your investment capital at once on Monday morning. Market open on Monday often brings deceptive price swings and artificial noise. Instead, split your capital into 3 equal execution tranches. Deploy the first tranche on Tuesday after assessing market momentum. Deploy the second tranche on Thursday during midweek price consolidation. Keep the third tranche in cash as a tactical reserve. A recommended portfolio ratio for next week is 50% broad ETFs. Allocate 30% to high-quality single stocks like Exxon and BAE systems. Allocate 20% to government bond funds for risk control. Always use limit orders rather than market orders when placing trades. Limit orders guarantee you buy at your target price or better. They protect you from slippage during fast market movements. Look out for our next video posted daily to stay ahead of the market.